All right, so welcome to today's video. What I want to share with you is a calendar versus a diagonal and when to use each. That is going to be the primary question that we had in our Facebook group. So went ahead and answered that, but I want to go in more detail with a little bit more context behind this. So as we go in and look into calendars versus diagonals, they are very similar, but they are slightly different in the way that you might use them or the vehicles depending on market conditions. They both have kind of like a positive vega if you set them up normally. Actually, double diagonal can have a negative vega or a positive vega, but that's a little bit more advanced. So anyways, we're going to go in and break down this concept. You can check out and join our Facebook group there if you want and see some great videos and training and education that you probably won't see in other spots. Okay, so first off, if we look at the SPX and we look at, I'm just using SPX as an example, a calendar, what you're really doing is you might buy, let's say, a 27-day and sell a 23-day against it, because the 23-day will decay faster than the 27-day. So what you're doing is you're doing kind of like buying stock and selling something against it, like a covered call, right? So this is the same thing. Stock is forever, and then selling against it a call. Well, this is the same principle as when you're doing a calendar. You're buying something longer duration, and then you're selling something that decays a little quicker to get the premium. So what you're doing here is at the same strike. That's a calendar. So let's say I go to 53.20 and I might right click buy and then just go to calendar over here. And I've got a calendar construction. Now these dates just have 1 day difference. If you want a bigger positive vega, what you can do is spread that to, let's say, more days. And look at that. Now you've got 22 Vegas. So the further you spread those differences on those dates, the more of a positive vega that you will actually have. Okay. So that's kind of one of the things to keep an eye on. Now, I'm going to keep it tight for now just to give you a little context and how these things work and operate. But anyways, let's say we've got this calendar. You could do calendars at the money. That's one way to do them. You could also do them out of the money. So that means, let's say I go to 5,400 and this one's a lot cheaper, but it's out of the money and I need that price to move over there. Now that has a positive vega, so it's actually more difficult to profit on there because vega will keep going down. Then you could also do calendars that are, let's say, kind of call it calendar bombs, and they are out of the money on the bearish side. You might decide to do those as a put calendar. So now you need price to actually go down. These are a bit cheaper to do than a diagonal because, well, you're kind of balanced. Now, what you can do also is, let's say we take this calendar. I'm just going to duplicate it. If you had some inclination of direction, or you had a preference of some sort, you could rotate these. And what's cool about rotation is I'll just move one strike. Actually, I have to rotate them. I'll have to switch from a calendar to custom. And then what I can do is move one strike up or down. And this will give me this rotation. And now I've got much more room on the upside. So it's kind of like creating an alternative to a vertical. And now I've got a more of a bias to a direction with a diagonal. Now this is kind of cool in that you can create all kinds of directions and rotations. Diagonals are one of the most flexible strategies. So you could decide how much rotation you actually want. So in this case, I might say, let's just do a slight rotation. But what you could also do is shift the whole thing to the left. And when you shift this whole thing, let's say 5280 and 5285, I could actually create a very subtle diagonal that's just looking for a tad bit of move to the upside, but then you've got a lot of padding here on the left. And you could do the same thing on the bearish side. So this is kind of when you would use maybe diagonals, is when you have some inclination of a move in a certain direction. These are also known as an alternative to a covered call, because if you really go in and let's say we are looking at something like this, it's kind of like a covered call alternative. So let's say I keep rotating and going a little bit more stronger on it, what you'll see is a risk profile picture that's very similar to a covered call. Anyways, I hope that helps. I mean, definitely check out the Facebook group or join it over there. There's a lot of great questions and videos that I'll post there as well. Or the newsletter list, there's great freebies. Check them out all down below. Truly appreciate you sticking with me. And, feel free to reach out if you're interested in our options black belt, covered calls program, or working together one-on-one. I'll see you next time. Take care.